Welcome to this Iron Financial Explainer. Look, our core mission here is to help you forge a much stronger portfolio and absolutely cut through the weakness of the broader markets. Now, before we start tearing down the balance sheets today, you need to smash that subscribe button. We are giving you raw, unfiltered market data, and you don't want to miss a gang. Because today, we are throwing a giant directly into the crucible. We're executing a brutal, deep dive forensic analysis of Dave & Buster's Entertainment. Ticker symbol PLAY. We're looking at their Q1 2026 earnings report, and let me tell you, here is the aggressive, unfiltered reality. We are looking at a company attempting to build this massive entertainment empire, all while the macroeconomic foundation of the everyday American consumer is visibly, violently shaking under stress.
Exactly, and this report is a fascinating structural paradox. It has sparked an absolute war here on the Iron Financial desk, because when I look at the hard data, I am seeing an unexpected, almost miraculous surge in free cash flow. To me, that suggests management is forging a deeply disciplined financial machine in the background.
Yeah, well, I am looking at the massive cracks in the armor. We've got a nasty top-line miss, severe consumer headwinds blowing right in their face, and a debt load that is frankly terrifying. So we have to ask the critical question today. Is this management narrative just a bunch of hype, or is it a genuine structural turnaround? We are going to drill down right now and force the data to answer that question.
So, here is the blueprint for today's structural analysis. Number 1. Top-line cracks in cash. 2. Margin compression. 3. Segment divergence. 4. Debt load and pivots. 5. The summer catalyst. And finally, number 6. The verdict. Market Skeptic, Section 1. Top-line cracks in cash, a 1.5% decline.
Let's just get straight to the ugly truth here. There is blood on the top line. Total revenue clocked in at $559.2 million. That's a 1.5% decline year over year. But listen, the real structural flaw, the thing that really scares me, is the comparable store sales. That took a heavy 5.4% drop. The macroeconomic scaffolding keeping this consumer afloat is buckling. We're seeing elevated gas prices, a very meaningful softness in broader consumer sentiment, and extreme targeted pressure on the lower-income consumer. All of that is driving this top-line weakness. The reality? People are simply not spending money at arcades right now.
Okay, but you really have to look past the top-line noise to see the actual engineering underneath this business. Let's look at the adjusted free cash flow. Look at that swing. In Q1 of 2025, Dave & Buster's burned through $58.8 million. Now look at Q1 2026. They generated a positive $25.3 million. Do the math on that. That is an $84 million cash flow miracle in a single year.
A miracle? Come on. Or are they just starving the business to make the quarter look good?
It's not starving, it's brutal, highly focused discipline. Management squeezed this cash out through incredibly strict net capex control. They completely slashed their full-year capital expenditure target. They brought it down from a very aggressive $270 million all the way down to $200 million for fiscal 2026. On top of that, they tightened up their working capital. That's essentially the day-to-day liquidity they need to operate the venues. They did the hard work to ensure cash wasn't just sitting there trapped in inefficient inventory or outstanding receivables.
And you can see it right here. This exhibit proves the cash anomaly is 100% real. The numbers are printed in black and white right in their SEC filing. They successfully converted revenue into actual cash on hand, despite those lower sales figures you keep bringing up.
But starving your engine of vital capital isn't a long-term growth strategy. It is a survival tactic. You can only delay floor remodels and hold off on buying new games for so long before the entire machine just breaks down. You cannot just stop investing in a massive entertainment venue and expect the American consumer to keep coming back. That $84 million cash flow swing, that is a short-term illusion, and it was bought by sacrificing long-term structural integrity.
Section 2. Margin compression under hammer, the earnings crater.
Okay, we have to stress test these operating costs because this is where it gets rough. GAAP net income absolutely collapsed. It went from $21.7 million, which was 62 cents a diluted share, crashing all the way down to $5.7 million, or just 16 cents a share. Adjusted EBITDA compressed from $136.1 million down to $123.2 million, leaving them with a 22% margin.
And let me tell you exactly why that happened. The operating payroll rose to $140.1 million. That means payroll is now eating up a massive 25.1% of their total revenue, up from 23.8% last year. Other store expenses hit $186.7 million, or 33.4%. What we are witnessing here is a textbook case of sales deleveraging.
Let's translate that concept for the retail traders listening right now because it's absolutely crucial. Sales deleveraging happens when your top-line sales drop, but your fixed costs, things like your rent, your massive electricity bills for the arcade, and your baseline staffing levels, those costs stay exactly the same or they climb even higher. That combination acts like a massive steel anvil on your business, completely crushing your net profit margins. Essentially, you're bringing in less money, but it costs you just as much just to keep the lights on and the doors open. And looking directly at the consolidated statement of operations, the heavy lifting that these operating payroll and store expense line items are forcing the overall company to do is completely exposed.
Exactly right. When your comparable sales drop by over 5%, like we saw, but your fixed store expenses remain entirely rigid, your net income gets squeezed until it physically fractures. The financial structure simply cannot support that kind of weight for very long.
All right, Section 3, divergence, food versus arcade. Listen, Dave & Buster's is essentially two completely different businesses living under one roof. And right now, those two segments are heading in entirely opposite directions. First, look at the food and beverage execution. It's actually phenomenal. They delivered 5% same-store sales growth. That marks 9 straight months of positive comparable growth for the kitchen. It's being driven by a very strategic return to their historic menu and this highly successful eat and play combo execution. Basically, they are attaching a $4.99 entree right to the Power Card purchases, and it's working beautifully.
Sure, okay, the kitchen is working. I'll give you that. But the other side of the model, the core side of the business, is collapsing. Entertainment and games revenues fell to $345.1 million. They are battling intense, aggressive couch competition. Mobile phones, high-end consoles, at-home gaming setups, these are actively keeping people out of physical arcades. Seriously, why go out, spend money on gas, and pay premium prices when the entertainment sitting right in your living room is cheaper and, frankly, easier?
And you have to remember, historically, amusements and entertainment make up over 60% of their total revenue. It is, without a doubt, their highest margin segment. So when the games revenue starts falling, the entire financial architecture of the company shudders.
Which is exactly why the company was forced to frantically roll out 10 brand new games in a single quarter. This was their largest floor refresh since way back in 2017. They are desperately trying to weld over and reverse a 6-year period of severe underinvestment in the physical arcade space.
Right, but think about the massive financial cost of that specific floor refresh. This is where a company that, as you just praised, is actively slashing its capital expenditures to save cash. They are forced to spend heavy right now to patch that gaping 6-year gap before the consumer abandons the arcade entirely. It's a catch-22.
Move into Section 4, debt load and structural pivots.
$1.495 billion. I really want you to let that number sink in. That is the raw, crushing weight of the long-term debt currently sitting on Dave & Buster's books. And against that massive liability, they have a mere $19.6 million in cash and cash equivalents. When you do the math, that results in a net total leverage ratio of 3.3 times.
Let's translate that specific metric for the retail traders tuning in. It means that for every single dollar of earnings power this company manages to generate, they are carrying over $3 in pure debt weight. That is a really heavy, heavy load to bear, especially in this high interest rate environment we are navigating.
Exactly. And when you stress test this balance sheet against a broader consumer pullback, servicing almost $1.5 billion in debt becomes a structural nightmare. Look at those liability line items. If the American consumer continues to retreat and those comparable sales continue to drop 5% a quarter like we're seeing, a leverage ratio of 3.3 times pushes this company perilously close to insolvency. The foundation will absolutely crack under that pressure. But listen, that exact debt pressure perfectly explains management's sudden structural pivot here. They are cutting new store development in half for fiscal 2027 and 2028, dropping it down to just about 5 new stores annually. Instead of building from scratch, they are actively prioritizing core store remodels. And here is why that is brilliant. These remodels cost 50% less than the legacy builds, yet they actively drive a massive 7% comparable sales uplift. To me, this is an absolute masterclass in capital efficiency. They are forging a much smarter, much cheaper growth path.
Are you kidding me right now? A masterclass? Let's ask the brutal, honest question here. Are they actually doing this because it is a superior strategy, or are they simply financially cornered? I argue they are too broke and too over-leveraged to afford real expansion. They aren't pivoting because it's some brilliant boardroom insight. They're pivoting because $1.5 billion in debt has completely tied their hands.
Section 5. The Summer Catalyst Hype Check. All right, management desperately needs a narrative right now to keep the market at bay. We need to do a serious hype check on their so-called summer catalyst, especially because management actually admitted on the call that Q2 to date comparable sales were still down 4%. So they are starting this critical summer season sitting in a hole.
Okay, but the CEO, Tarun Lal, has laid out a very aggressive 360-degree World Cup strategy to dig out of that hole. Here's the play. Step 1. They are launching $24.99 ticketed hat-trick watch parties, complete with all-you-can-eat wings. That is going to heavily drive that food and beverage momentum we talked about. Step 2, they are placing actual World Cup tickets inside their massive human crane games. That is a direct play to drive up that high-margin entertainment revenue. Step 3, they are completely shifting away from their failed television ads, moving heavily into highly targeted digital media modeling.
Look, I have to force the issue here. They are battling a 4% comp deficit as we speak. Are human cranes and some all-you-can-eat chicken wings really going to be enough to fix a structural macroeconomic weakness? Is this strategy going to create genuine, sustainable momentum, or is it just a temporary Band-Aid slapped over a rapidly decaying core business?
Well, the CEO gave a very critical admission of their past marketing failures here. They were running this dollar-per-day messaging strategy on TV, specifically trying to attract budget-conscious families, and it completely misfired. It didn't resonate.
Exactly. And that connects directly back to the lower-income consumer pressure we discussed at the very top of this explainer. If that old TV strategy failed to hold up the top line because the consumer is tapped out and stressed, will these new, supposedly culturally relevant, data-driven promotions actually forge a stronger connection? Or is this just going to be more burned capital thrown at a consumer base who literally cannot afford to walk through the front doors right now?
Section 6, the final ironclad verdict. We have broken down the top line. We've stress-tested the margins. We've audited the debt structure, and we've interrogated the summer catalysts. Now, we bring this Socratic debate to a close. Here is my final stance. Management has explicitly targeted generating over $100 million in free cash flow for the year. If they hit that target using their highly disciplined remodel strategy, this is a massive operational victory. They are building a high-yield cash flow machine right under our noses.
And here is my final stance. You simply cannot out-operate a $1.5 billion debt load when the American consumer is actively retreating. It is a macroeconomic consumer trap, plain and simple.
So here is your ironclad takeaway. For retail investors and day traders looking at PlayStock right now, this is currently a high-leverage turnaround play. The cash flow anomaly we saw proves that management does have the discipline to squeeze capital out of the business by slashing CapEx and pivoting smartly to cheaper remodels. However, carrying a 3.3 times leverage ratio while your comparable store sales are down over 5% means they have absolutely zero room for structural failure. None. If that World Cup summer marketing catalyst doesn't hold up the top line, the massive weight of that debt will eventually crush the equity. We want to leave you with this final provocative thought. Will Dave & Buster's structural pivot, abandoning aggressive expansion for defensive remodels and cash hoarding, actually hold the weight of a highly stressed American consumer? Or is the foundation of this arcade empire already cracked beyond repair? Take these numbers, apply them to your own models, and never stop questioning the narrative. Thank you for joining this explainer, and we will see you on the next deep dive. Keep forging ahead.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.